Today I'm going to talk about my 20 grand loss and the mistakes I made that caused this and the lessons that I have learned so far from this. Now a lot of you are going to go, well, you haven't truly learned from your mistake yet as it is still ongoing, and you may be true. But at the moment I feel that I've made some good revelations, something that I can add to my investment strategy, and I think this is such a valuable set of lessons that I've learned that I feel that it is irresponsible if I do not share it with you. So for those of you that don't know, my portfolio invests in stocks that I believe are going to grow over the longer term. I do this by investing in individual companies. Now I do this because I believe that I have a better shot at outperforming the market if I choose the businesses that I believe are most likely to succeed over the longer term, as opposed to investing in index funds where you're likely buying a lot of companies but you conform to the average because you're buying some of the great companies but also some of the not so great companies. That said, index funds in some cases can obviously choose the surviving companies, but the problem is with this is that just because they've continued surviving, it builds a survivorship bias because these businesses might have been quite good, but maybe they don't align with my strategy of looking for capital growth. They might be very mature businesses with limited growth potential but pay out a dividend, and therefore this is something that I wanted to avoid in my strategy. So what's happened in my portfolio? So if we actually jump into it here, you can see that my portfolio is down 57.9% over the period of about 879 days. Now this investment strategy over this time period has changed quite dramatically. However, what has happened in the last year and a half, what I decided to do is slim down my holdings significantly. I felt that by holding a smaller number of stocks, I had a greater exposure to each of them, and therefore I could obviously have a greater potential return by only investing in what I believe to be my best ideas. That said, these stocks have dropped quite significantly since my average prices, and in fact I've bought at higher prices than the averages bought shown on the screen here, so there are quite some dramatic falls. A majority of my capital losses lie with Boohoo, a stock that I'm down £16,800 or down 67%. Another one of the stocks where I lost half my money, but it would be a lot more now, is Argo Blockchain, where I lost about 3 grand here or there as well. Now, you've seen my losses and you've seen what happened. Sure, I've bought at a higher price and therefore I've failed to value it properly. That's true. That is a mistake there, and valuation should be key. But there is more to this. In fact, I was quite excitable. I averaged down very quickly. Investing is a slow game. There's no need to be buying large quantities of this in such small time horizons. I was seeing Boohoo drop to £1.20 a share and thinking, wow, this is a fantastic deal. I started buying this at a much higher price. This company's on a discount. I'm very interested in this, so I'm going to buy more, lower my average down, have a great position for the longer term. Now, don't get me wrong, this is a strong strategy, but there's no need to rush in terms of doing this. Why would you? If I instead had some discipline and went, okay, you know what, look, I get paid every single month. I'm going to allocate this amount of money into my portfolio every single month, £1,000 a month in this portfolio, and I can invest however much of that as I please into that stock. Then, if in a month's time the stock price has dropped by 10%, well, good news, because I can invest another £1,000. Oh no, the stock price has gone up 10%, that's fine, because the money I invested last month has now generated some returns on the initial investment. So therefore, it's a better and more moderate strategy that I think are something that I needed to add and adapt from. So this is something that I'm currently doing. And in fact, I have bought more shares of Boohoo very recently. You can see it in my portfolio here that I now have an average of £1.33 per share. Now this has dropped by about 7 pence per share since my last update, which was about a month ago. So this is quite a significant average down. I only bought about £500 worth of shares. That said, I've also learned another thing, and that's the markets can remain irrational for longer than you can remain solvent. That said, I'm not taking on liquidity, or I'm not taking on any debt. This statement here doesn't really matter. What I am saying is that the markets can remain irrational for such a long period of time that it may not be wise to have such a high exposure to a handful of companies. That said, I only hold 2 stocks at the moment, and a majority of my losses stem from my largest position. I mean, I'm down 66% on that position. That is definitely a significant swing. That said, whilst I still believe these are my best ideas and I do think they're going to do very well over the longer term, my position or my risk management or lack thereof had put me in a position now where my portfolio is down significantly. If you're looking to preserve wealth in your investment strategy, then I have absolutely failed at this. I do obviously have a good reason for this. It's because I'm young, I'm able to take on more risk, and therefore I did this in the first place, but there is a lot of unnecessary systematic risk as well. I don't think Boohoo or Games Workshop are going to go bankrupt or fail in any way, shape or form, and that's why I continue to buy both of them consistently each and every month. That said, I do think an element of caution was required, and it's easy in hindsight to know this, but I do think holding another 2 or 3 stocks doesn't really impact my overall upside potential, but certainly would help out in the case of one stock performing badly. And in that situation, if that stock is performing badly in the markets, it's the emotion behind it, the sentiment behind it is not so good, but actually underlying on the terms of the fundamentals and the actual quality of the business is still good, then I can allocate that money that I'm getting every single month into that stock and buy a bit more, whilst also knowing that my other 4 positions are well placed. A lot of people at me on my diversification here. They go, well, you hold 2 consumer stocks. That's awful. How could you do this? This is not diversification. You're a fool. Right, okay, and that's a reasonable spot. That said, these 2 stocks in terms of diversification are very different. Whilst yes, they are both consumer companies, they do operate on 2 different ends of the spectrum, and I think it gives me very good diversification in terms of consumer on that end, in terms of cyclical or discretionary as you may call it. I do believe that I need to hold a more diverse company. I may even choose to hold a very small allocation to an index fund as sort of a buffer in the portfolio, so that going forward, if there is an extended period of downturn, perhaps this buffer stock or index can provide some dividend income. I can reinvest that, or it just provides a bit less volatility in the portfolio by holding its value better than my other companies. And at that point, I might decide, oh, actually, my stocks are down 50%, my 2 biggest holdings, but my index fund is holding its value. So perhaps I'll trim some of my index fund and buy more of my 2 fallen stocks at a depressed price where I can get a better value on it. And hopefully over the longer term, those 2 stocks recover because I believe in them. And I therefore will generate further capital returns on that investment. So you can tell here that I've learned quite a few lessons from this. And no doubt there's more that I'm going to learn over the next few months. A lot of people have been saying, oh, look, he's actually crying underneath. He's actually really upset. And quite frankly, I'm not bothered in the slightest. I really respect the lessons that can be learned here and the path that is being taken. After all, I think the primary thing behind investing is the psychology. It's all about maintaining your frame, making sure you're in a very good mental position. And I think over the longer term, that sets you up in a very strong point where you can make money in the stock market. Now, I've got a life hack for you here, and that is, if you have a case of hiccups, say the word fish. Now, I learned this recently from a festival, but there's a Reddit thread that also says about this, and it's the idea that you can say, I am not a fish, and the hiccups will stop. Now, this is something that you should totally try out, and you might be going, well, he's having me on here, there's no way this will work, but try it and see what happens, because you might be pleasantly surprised, and it is such a random thing to even consider that it absolutely baffles me in the slightest. Another one, a good one, is if your friend has got hiccups, go, what swims in the ocean? They'll say fish, and boom, it should work. But the Redditor did say it only works once, and for the first time you hear it, but it is interesting indeed. Have a fantastic day.